No matter if you've already gone completely paperless or still have a closet, garage, or attic filled with mystery financial documents, it's critical to know which records to safely toss or keep and for how long. This podcast will review how to tidy up your record keeping and save space without violating IRS retention rules as we approach a new year and a new tax season. Welcome back, everybody. It's episode 979 of Money Girl. I really appreciate you being here, spending a little time with me. I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. Free subscribers automatically receive my Money Success Toolkit. It gives you the exact templates I use to manage my money. You can learn more, ask money questions, and, of course, sign up for The Money Stack for free at lauradadams.com. Or you can leave me a voice message with your question or comment by calling 302-364-0308. I'd love to feature your question on Finance Friday. That's our weekly Q&A bonus edition of the show. All right, let's get into 7 tips for keeping and tossing financial records. I'm just going to confess up front that I used to be one of those people that would keep just about every financial document that came into my hands because I just thought I might need it later. And of course, I usually never did. I had plenty of space and a giant 4-drawer filing cabinet where paper went in and it rarely came out. Well, it's been a while, but I mentioned on the podcast that I had to face this problem when my husband and I moved from Florida to California over a decade ago. Now we're back in Florida, but this was our first cross-country trip. And not only did that filing cabinet weigh a ton, and long-distance moves typically are priced by weight, but I also knew it was filled with really old documents that we did not need to lug across the country. So that's when I committed to going paperless, and I began shredding unnecessary documents like a madwoman. I probably filled 30 huge lawn garbage bags with confetti over a grueling weekend. And now I have just a few physical paper files that take up very little space. So I'm going to review 7 tips for keeping and tossing financial records. Number 1, the first tip is go paperless. If you're still receiving some or all of your financial documents by snail mail, like bank account statements, investment statements, utility bills, or insurance policies, you should request to be a paperless customer. That saves time managing all that paper. It reduces storage space in your home, and it's, of course, better for the environment. Set a goal to eliminate all incoming paper to simplify your life and help avoid becoming a victim of identity theft. It's really easy for a thief to get your personal information from old-fashioned paper records. If you can get a statement or bill online, you typically don't need to keep a physical copy. However, there may be situations in which a financial institution offers free access to statements for a limited time. And in that case, you can download e-documents to your computer or to cloud storage to save them, or maybe print them later if you need to. I want to challenge you to continually pare down what you receive in the mail. Every time you open your physical mailbox and you see some paper in there that you don't want or need, contact the sender to be taken off their mailing list, or when possible, request to go paperless. If you get a lot of junk paper mail for things like pre-approved offers, maybe it's credit cards or insurance, and these are things you really don't want, you can visit Opt Out Prescreen. That's optoutprescreen.com to get off lists that are maintained by the nationwide credit agencies. And that site, it's free to use, and it is the official place where the credit agencies must accept and process consumers' opt-out requests. And again, that's optoutprescreen.com. I'll put a link to it in the show notes. All right, the second tip is use online bill pay. If you rely on receiving a paper bill to make a payment, consider using a bank's free online bill payment service. That lets you get digital bill reminders and stop writing and mailing paper checks. Not only are paper checks costly, but they can also be stolen and increase your chances of becoming a victim of identity theft. Online bill pay lets you pay any company or any individual with a mailing address. The service sends money electronically when possible or prints and mails a paper check for you for free. Many banks can request e-bills from the merchants you set up, like insurance companies and utilities, and they act as a centralized hub for all your necessary payments. Or you can set up automatic payments. You can enter bills manually and receive alerts when a bill is due or paid. So it's just a really convenient way to manage your bills. With online banking, you can see your pending payments, what your future balance will be after the payments clear, and the payment history for each of your bills. Online bill pay is an excellent way to ensure all your bills are paid on time, so you eliminate late fees and boost your credit scores. In addition, most banking apps allow you to deposit paper checks remotely by taking a photo of the front and back. The funds are typically credited to your account immediately, saving you a trip to the bank. Tip number 3, know which paper records to keep. For most people, there will be some paper documents you should keep, and that's only because they're impossible or difficult to replace if you lose the original. Even if you have a digital copy, I recommend safely storing the following paper documents: adoption papers, birth and death certificates, citizenship papers, deeds and titles, documents with raised seals and notarized signatures, education records, immunization records, marriage and divorce papers, medical directives, military records, passports, powers of attorney, social security cards, and wills and trusts. Also, keep any tax-related documents that you may not be able to get online, such as paperwork for gifted or inherited property, investment statements, promissory notes, real estate closing documents, receipts for capital home improvements. So these are things like renovations, replacing a roof, installing a pool, etc. And records on any non-deductible traditional IRA contributions, and you should be recording that using IRS Form 8606, non-deductible IRAs. In general, you should keep records related to real estate for a few years after you sell the property. You or your accountant needs these records to report depreciation and capital gains or losses and to prepare any amended tax returns. So consider storing essential paper records in a home safe or a fire-resistant locking filing cabinet. And for added protection, put your essential documents in an airtight plastic bag like a Ziploc, and also keep digital copies if the originals get destroyed. Tip number 4, digitize your tax returns. So speaking of taxes, the IRS allows you to keep digital copies of your tax returns and the supporting documents for your income and any tax deductions and credits that you claim each year. In general, individuals must retain tax returns and the supporting documents for at least 3 years. That's because you've got up to 3 years to file an amended return or be chosen for a tax audit. However, you can claim a loss for certain investments for up to 7 years. So if you have complicated transactions like the purchase or sale of investments or real estate, it's wise to keep your tax records for 7 years. And while keeping 7 years of taxes might sound like a lot, the good news is that digital files are very easy to maintain. So scan your tax returns or ask your accountant for a digital copy instead of adding more paper to your filing cabinet. If you have a business, the IRS says you typically need to keep business tax records for a minimum of 7 years, but they can be digitized too. Tip number 5. Know how to reduce your taxes. I mentioned tax deductions and credits, which are powerful ways to reduce your tax liability or increase your tax refund. So here's a quick primer and examples of valuable tax-related expenses and documents you or your accountant may need to keep. A tax deduction is an amount you can subtract from your taxable income, and that lowers your tax liability. For example, if your taxable income is $60,000 and you're eligible to claim $10,000 in allowable tax deductions, you only pay tax on $50,000. And a tax credit is very different. This is a dollar-for-dollar reduction in the amount of tax you owe. For example, if you owe $5,000 in taxes, getting a $1,000 tax credit means you save the full amount and only owe $4,000. For 2025, here are some of the most common tax-deductible expenses you may be eligible to claim. You've got state and local taxes, including real estate taxes, up to $40,000. There is home mortgage interest that you pay on debt to buy, build, or improve a primary or secondary residence for loans up to $375,000 or $750,000 if you file a joint tax return. There's qualifying healthcare expenses that exceed 7.5% of your adjusted gross income, and health savings account or HSA contributions up to $4,300 for an individual or $8,550 for family coverage when you have a qualifying health plan. There are traditional workplace retirement plan contributions up to $23,500 or higher if you're over 50, and there are self-employed retirement plan contributions up to $70,000 depending on your business income. You've got traditional IRA contributions up to $7,000 or $8,000 if you're over 50. You can also deduct student loan interest up to $2,500 if you meet income limits. And for the self-employed, there are various expenses such as 1/2 the self-employment tax, contributions to a qualified retirement plan, and health insurance premiums. That's not a complete list, but just some things to think about when you're keeping records for your tax return each year. Tip number 6, manage digital files wisely. As you go as paperless as possible and digitize necessary financial records, you'll probably find that you only need a small drawer for essential documents. Just be sure to keep your digital files organized and secure. For instance, consider keeping your digital records in multiple places so your information can't be lost in a computer crash or a fire. You might store them on your computer, in a password-protected external hard drive, and in the cloud. To stay organized, you could create a main folder for each year and subfolders for categories like taxes, investments, paychecks, and any other documents you might need in the future. Add a layer of protection by requiring a password to access your main folder. And keep your computer's operating system up to date to ward off cybercriminals. Once you create a plan for storing your documents, make sure your loved ones know where to find them in an emergency. In my experience, going paperless and organizing your digital files in multiple places makes you feel more in control of your finances. And lastly, tip number 7 is to get professional advice. If you're unsure which personal or business documents you need to keep or for how long, ask a pro, like a tax accountant, an attorney, or a financial advisor. In addition to the documents I reviewed, you may have other records or contracts to keep for legal or business reasons. To sum up, if you can get documents online, like credit card statements, bank statements, and insurance policies, there's really no need to keep them as paper or digital files. But when you have documents that are not permanently available online, like deeds, titles, investment purchases, and real estate closing documents, you want to keep the physical paper records for several years after you sell those assets. In general, it's wise to keep your tax returns for at least 7 years, especially if you digitize them and, they just don't take up any space. However, you need to keep the originals of certain vital records forever, or at least until you're sure you no longer need them, and you got to keep them in a safe place. Some forever files include birth certificates, Social Security cards, Form 8606 for non-deductible retirement contributions, and documents with raised seals and notarized signatures. Make getting financially organized a priority right now, or set it as a New Year's resolution. You'll feel more in control of your finances and save time so you can spend it doing something you actually enjoy. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we've got a great team that works on the show. I want to thank Steve Rickyberg, our audio engineer. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. Rebecca Sebastian is our marketing and publicity manager. And Nathaniel Hoops is our marketing contractor.